Okay. All right. So as you all know, this call is really designed for people who support clients through the real estate process. So many of you are obviously aware of the situation that we've had where the pandemic hit. Obviously, economically, we've been through some struggles, especially for small businesses really getting hit pretty hard. Some companies really thriving in this environment, depending on the type of industry that they're in, and some really struggling. So what I'd like to do today is to give you a quick overview of what we're going to cover. So first of all, a little bit of a history of what happened during the pandemic and how banks responded, and also talking about how that has changed a little bit over time. Obviously, we're approaching a full year since this situation started. We'll go through some details on how underwriting has changed, how this is impacting self-employed applicants, which is probably the most hardly hit group of any. Performers, business owners, entertainers, all these types of people are really getting affected probably more than anyone. We'll talk about how PPP loans and forbearance on existing mortgages can affect a client's ability to get a new mortgage, and what we're looking toward the future for. How do we overcome these issues as professionals who support people's finances and real estate needs? How do we help them get through this? And also talking a little bit about where certain opportunities may be from this situation. Obviously, nobody would have asked for this pandemic to hit, but with any situation, there may be some silver linings. So we'll talk about those. And then, as I mentioned, we'll do a Q&A as well. So I'm going to stop sharing so you can see me a little more clearly here. So a little bit of history on what happened with the pandemic. So obviously, economically, we got hit pretty hard, businesses shutting down or being forced to close their doors, or at least not open in the same way that they would normally be able to open. That has obviously rippled through the economy in many, many different ways. So what happened was, whenever there's been a financial crisis, and this is now my third one that I've been through, not really a claim to fame, but the reality is that we've navigated clients and business partners through these types of situations now 3 times in the past. So we've gotten to see some of the patterns that have happened. So what banks do when there's uncertainty is they start to pull back. So they cut guidelines. They can require higher credit scores. They can require that clients have more money in the bank after closing to be able to accommodate any shortfall of cash or bleeding of cash, so to speak, that they may have with their business if it's not operating at full capacity. So one other thing that happened when this pandemic first hit, within the first few months, is that the flow of cash through the mortgage industry shut down temporarily. And it wasn't fully through the whole industry, but a big segment of it for loans that are securitized. So in many cases, loans are packaged on the secondary market and they're sold off to investors in the form of mortgage-backed securities. Not to get too technical here, but if anybody saw The Big Short, you'll know what I'm talking about. And what happened was, because there was so much uncertainty as to how this was going to affect the economy, if we were going to go through a massive recession, banks got really nervous. And the way that mortgage money moves through the system is that banks borrow money temporarily to be able to lend out, and then they sell those loans. And when they sell them, they replenish that cash and pay it back. And that process repeats itself on a mass scale over and over and over again. That's how typically the industry is structured, and for most types of loans, not necessarily portfolio lenders, but a large segment of the market. So when the economy really started to tighten, a lot of those banks that supply those warehouse lines or funding for those loans pulled back, and some of them shut down completely with certain types of loans, especially those that are non-traditional, like if you're familiar with bank statement loans, or just anything in what we call the non-QM space, the non-qualified mortgage. So basically not a government-backed 30-year fixed loan. So that got pared back significantly, and that's why you may have seen why some of these products have disappeared, at least temporarily, or they've gotten cut back or become more difficult to get than they had been before, Maybe the requirements are stiffer, or they're only allowed on certain types of properties, or only for a primary residence, or whatever it may be. The other thing that we saw is when this happened, the government's response to try to keep the economy as strong as possible, or one of their responses, was to indirectly, but somewhat directly, lower interest rates. And so they figured that with lower borrowing costs for applicants, are going to have more disposable income to spend on other things, despite potentially being locked at home, temporarily during the pandemic, depending on what state you're in. Some are locked down more than others. And we do have people joining from all across the country today. So depending on how that impacted your area, everyone is different. And the interest rates dropped so substantially that almost every single person who has a mortgage, who got a mortgage in the last 30 years, became a viable candidate for a new loan, for a refinance. Or maybe it forced some people to say, you know what, I don't like my current home, I want to move. Or I want to sell my home because I'm worried that the value may drop for whatever reason. And these reasons were different in different markets because they all responded differently. So we've seen New York City, maybe, people were moving away from New York City for a period of time. That has now ended, I think, to a certain degree, and other areas that just flourished during the pandemic, and values actually went up. But all this activity in the mortgage industry, in some cases, could have been 4 or 5 times normal volume. So what happened was banks were just absolutely inundated. No matter which company you worked for, which bank you were at, or which direct lender, you now had a massive influx of loan applications. And no lender could possibly have prepared for 5 times the normal volume all at once. So what happened was we started to see timelines take longer. We started to see underwriting take longer. And this is industry-wide. This is not specific to where I work personally at Freedom Mortgage. Underwriting turn times took longer. Appraisals started taking longer. We'll talk more about appraisals specifically. Every part of the process, and every company that supports the real estate process, whether it be title, appraisals, inspections, closing, whatever it may be, all experienced this volume that they had to get through. So what happened was, because there was no additional massive amount of capacity, because no bank could possibly, or company that supports real estate could possibly staff up in time, we started to see these timelines get longer and longer and longer. Fortunately, during the holidays, that volume of loan applications naturally will slow down, even though the rates haven't gone up any. So we did see banks it gave them a little bit of time to kind of catch their breath a little bit. Some are much more caught up than others. I know our underwriting is moving at warp speed right now. So, but a lot of banks are still quoting several months to close, for example, a refinance. Now, what we see is that pretty much every bank, if they're being smart about how they approach things, will prioritize purchase transactions over refinances. But if you have any clients that you support who are trying to do a refinance and they're 3 months in and they're not sure when they're going to close, it could still be another 3 months with certain lenders. So, and retail banks tend to get hit harder just because of their sheer size. So their timelines tend to be longer with refinances than a company like ours that's more manageable. So appraisals in particular have become somewhat of a challenge, or had been. It's a little bit less so, again, because some of the activity has slowed a little bit during the holidays and is now starting to pick up as far as, depending on where your market is. But what we saw is that appraisers were in such high demand for refinances, as well as markets where purchases were speeding up like crazy because people wanted to move. They were uncomfortable with their current housing situation, or relocated for a new job, or whatever it may be. Appraisers got really backed up. And so what we had seen was they just couldn't accommodate the number of transactions they were being asked to do or to bid on. So what happened was typical supply and demand. So demand was extremely high. Supply of appraisers hadn't really changed. You can't just all of a sudden become an appraiser. There's all sorts of training and licensing that you have to do before you can get into that industry. And so what happened was the amount of time that it took to get appraisals done got significantly longer. And what we found, and this is something unfortunately that has not yet been regulated in this industry, And I think it might warrant a look, even though I'm not a fan of oversight to a strong degree, but I do think it would be warranted in this case, is that appraisers started to raise their prices substantially. And we had some very extreme cases where an appraisal maybe cost $3,000 for a higher end property, whereas normally it might cost a third of that. And basically appraisers were bidding jobs and saying, if you want me to make this report a priority, and this is not them just saying this to us, this is through an independent third company that hires appraisers and bids out the jobs. If you want me to do this report, I'm going to charge you an arm and a leg. And if you don't like it, then I won't do the job. And because there was such a scarcity of appraisers, in some cases, clients had no choice but to accept whatever the cost was. And so the cost of appraisals, because of, again, low supply, high demand usually means higher prices. That's exactly what happened with appraisals. And again, they took longer to complete. So those were some of the sort of historical implications of what we've seen happen. Again, this has started to lighten a little bit because of the holidays, but there are some that are predicting another wave of refinancing again this year, where rates could potentially creep up a little bit and then dip back down again. And anytime you have that dip, even if you were at that similar level before, it does create more activity. So it's very possible that this could repeat itself, maybe not to the same degree, but it's something that we're definitely watching out for. So some of the changes that we've seen as far as underwriting and whatnot, every lender has reacted differently, and some are more comfortable with certain aspects of loans than others. So what we've seen is a general tightening of guidelines. So it could be for some lenders that they're no longer doing higher loan to value ratios. It could be that they're requiring higher credit scores. It could be that they require more reserves because they're nervous that people are going to burn through their cash. So all these different implications change, and there's different risk factors as far as different types of loans that banks are also comfortable with. So you may have seen some lenders stopped during the pandemic doing cash out transactions. Some of them stopped doing interest only loans. Some of them stopped doing investment properties, or maybe some combination of cash out on investment properties or something to that effect. But you've seen, and home equity lines is another one, where big retail banks that normally would be a very competitive source of a home equity line, they just didn't do them anymore. And some of them still aren't, because they don't want to have to be on the hook to provide capital to people who may be struggling. One of the other significant implications that we've seen is that banks are now looking at documentation all the way to the current date. So if you have a client, for example, who's self-employed, and under normal circumstances, we would typically look at a 2-year average of their income. Certain government loans, like backed by Fannie Mae or Freddie Mac, would not require a profit and loss statement as a standard course of business before the pandemic. Nowadays, the underwriters are so concerned about how the pandemic has affected people's financials that now the documents that we review have to be much more current. And that's inclusive of requiring profit and loss statements, sometimes up to the very current month prior to closing, balance sheets for people that own businesses, because they're wanting to make sure that if they're looking at tax returns, that they're reflective of current income, not income from the prior year's tax returns. So right now, for example, we're in a situation where the IRS doesn't actually accept tax return filings from the prior year until about mid-February. So if a bank just looks at tax returns, the only returns available are going to be from, most recently, from 2019, which obviously was before the pandemic started. And even in 2020, it may not have felt the full effect of the pandemic. So we're seeing that banks are requiring these profit and loss statements to make sure that income isn't falling off in the current year or in the prior year if there's no tax returns filed yet. So those documents have to be very current, because banks, again, are very nervous about people not having the same amount of income that they had before. And an underwriter's job in general is to try to predict what the future will hold for that business owner. Obviously, that's somewhat of an impossible task and somewhat subjective. But when we have a client whose income really has dropped off, it becomes our job as experienced loan originators to be able to make a case for that client to still get approved for that loan, even if the income has fallen off. And this is affecting people at all levels. So we have clients who are very well-known entertainers who, musicians, for example, who are not touring this year because of the pandemic. And we have small business owners who, maybe make $100,000 a year, but now they're making 50. So it affects everyone from top to bottom as far as the economic scale. And this is something, again, that banks are being very cautious with. So in the event that the income has dropped, what we typically have to do is make a case to the underwriter, almost like we're going in front of a jury, so to speak, where we have to build evidence to show that this client actually has stable income, maybe with future contracts that they have, could be business that they've already booked, but maybe haven't paid for or haven't been paid for, where they're already completed the job. So it could be any number of things. For our entertainment clients, sometimes it's showing contracts with Netflix to show that even though they're not recording new material, they're still getting paid through residuals of or releases of shows that have already been filmed. So it can be a number of different ways that it plays out. But the general theme is that we have to show proof that their income is going to continue in order to get that loan approved, even if their prior tax returns show more than enough income to qualify. So self-employed borrowers specifically are probably going to get hit the hardest, as I mentioned before. The reason being is how underwriters typically underwrite income for self-employed applicants. So it's typically, industry standard is a 2-year average. There are some programs that only require 1 year, but let's just say industry standard is 2. So when you look at income that may be dropping this year compared to prior years, let's say it started dropping in 2020, and let's hope, knock on wood, that income starts to rebound in 2021, but it may still be not the same type of year that it normally would be because we're still obviously dealing with the pandemic and the fallout from that. And maybe it'll go beyond that, but let's say not. So income on a current tax return, either for 2020 or 2021, may be still meaningfully impacted by the pandemic. And when underwriters look back at a 2-year average, they're not going to take it lightly that the income dropped off. So what that means is that income from this year, from 2021 and 2020, is actually going to affect the client's income calculation on a loan application for at least 2 years beyond. And if you think about logistically when a client can actually file tax returns, most of them don't file within the first 6 months. Most business owners usually file very close to the October 15th extended deadline. So it actually could affect them for another 3 years if their income is dropped in 2020 and 21. So that's why we think that the self-employed applicants are going to get hit the hardest and the longest, just based on the logistics of how their loans get underwritten. So that is something that we anticipate is going to be a problem for people for a long period of time. And we'll talk about a little bit later what the solution is for that, and how the industry may have to change to accommodate those types of clients who are potentially very, low credit risk, but as far as traditional income verification might not quite fit into the box. The other thing we've seen with self-employed applicants is that a lot of them took these PPP loans, which are basically, for those who may not know exactly what they are, they're payment protection plans. So it's basically a loan to try to keep your staff employed. And the government does this because they want to keep people from losing their jobs and having massive unemployment. So, but from an underwriting perspective, banks don't consider that to be income. So if you have a client whose business is only being supported financially, they're only, making money, so to speak, because they got that PPP loan, it may actually on paper to an underwriter look like a loss. So if you have a client who had, for example, a $200,000 profit, but they got $100,000 in PPP money, the actual income from an underwriting perspective is only $100,000. So that's something that we're dealing with as well, because a lot of our clients who send us a profit and loss statement will include the PPP money because it was money coming in, but an underwriter will actually back that out because they don't consider it to be income. It's clearly not income you're going to receive every year on an ongoing basis. So they only approve based on the actual revenue from the company, not loans from the government. They don't consider that to be income. So that can create a challenge where the profit and loss statement actually looks worse than what it might look like on the surface, and something that we need to be mindful of because we cannot count it on a profit and loss statement. We've also had situations where underwriters, especially on jumbo loans, have actually looked at specific industries that they're uncomfortable lending to people within. So I'll give an example. We had a client in the Bay Area who was a hotel developer. And during the heart of the pandemic, theoretically, there were a lot less people traveling. I think there probably still are. That's a safe comment there. And so we had a very difficult time getting this gentleman approved, even though we did in the end. But it was very difficult because underwriters were concerned that maybe his income was reflecting high now, but it could have a very significant impact on his revenue. So he was perfectly well qualified, plenty of income, plenty of money in the bank, but we still had some difficulty in getting that person approved just because of the industry that he worked in, and even though he had taken very smart measures to ensure that his hotels remained occupied, whether it be by government agencies or whatever it may be, but there was still a concern just about the industry that he was in. And it took us a couple of tries, and eventually we got the loan approved. But it was potentially a problem just because of the industry that he was in. So these are challenges. And also with that same client, we had a situation where he had taken PPP loans for each of his hotels. And some lenders just said, you know what, there's just too much risk here. There's the industry, the fact that he took these loans, even though they were probably going to be forgiven, it was still potentially a problem when they look at the overall risk of that transaction. So even if you have a client who shows enough income on paper and is still doing well, there are still unusual challenges that we have to face in the mortgage industry to be able to overcome those concerns that an underwriter or a lender may have. So talking specifically about PPP and forbearance, banks have different guidelines on how this works. It's not uniform across the board, unless you're talking about Fannie Mae backed loans, government types of loans, FHA, VA, Fannie, Freddie, those types of lenders. They have more uniform guidelines, obviously, because it's one type of financing. As you get into the jumbo financing market, you see different requirements for each of these situations. So let's take the government loans to start with, because that's the easy one. So if your client participated in some sort of PPP program, as I mentioned, the income is generally not counted. I would say that applies across the board for most lenders. If they participated in a forbearance program where they stopped paying a debt, primarily a mortgage, for a period of time, they can still get a loan, a new mortgage, as long as they have now come current on that forbearance plan. Now, if a lot of lenders were offering that the missed payments, let's say it's for 6 months, gets added to the end of the loan, that is fine, as long as the client's not currently in default of the forbearance plan, and as long as they come out of the forbearance plan prior to closing, then they can get that loan approved. Jumbo lenders can be different. Some of them follow Fannie Mae guidelines, some of them do not. The ones that do not, in a lot of cases, we've seen a requirement that the client has to be removed from that forbearance plan for a full 6 months. So I'll give you an example. I just had a client email me this morning saying, I'm trying to cash out on my home in Brooklyn, and I want to be able to do some renovations, but I need to cash out a couple $100,000 to do it. She just came out of forbearance about 2 months ago. So that may dictate that we need to take that loan to a Fannie Mae type of product, even though the interest rates might be a little bit higher than a jumbo loan normally would be. She might not be eligible because she's only been out of forbearance for a couple months, unless she waits another 4 months to apply, and that would create some challenges with the renovation that she wants to do. So these are the challenges that we are dealing with fairly regularly. So there may be a waiting period for certain jumbo loans. So if you have a client that participated in one of these programs, you need to let your lender know, because if they don't know it, they'll likely find out at some point when they do all the verifications that banks do, many of which are behind the scenes that you would never know about or see. Very standard to do searches on, on existing mortgages and make sure that everything is in order, and all other sorts of searches as well. So if you know that your client has participated in this, don't try to hide it from the lender. They will find it eventually. It's better, in my opinion, to address these things head on and make sure that your lender is aware of it so that they can try to find a solution for you up front before you're halfway through the transaction and all of a sudden you hit either a dead end or a fork in the road where you have to make a shift. So these are things that you want to be mindful of and proactive with so that you can manage the process for your client and make sure that they get through that transaction effectively and without any major hiccups along the way. So as far as what's going to happen from here, right? So that's an important part of this. I hope I haven't depressed all of you with all this information about all the challenges that we are facing. But there are some silver linings and there are some solutions that I definitely want to cover today. So first of all, we have started to see some of the programs that got cut during that time where mortgage-backed securities were kind of stopped in their tracks and the flow of cash for non-traditional or non-QM mortgages weren't happening. So some of those programs have started to come back now that there's been evidence that most real estate markets around the country have either rebounded from an initial short-term drop or potentially have actually flourished during the pandemic. I think there's generally less concern about property values dropping, which was one of the major concerns that banks had up front, and that's what led to one of the biggest financial crises in the past. So that, I think, banks have gotten more comfortable with now that they've had time to see how the real estate markets have reacted to this. Whether that's creating a bubble is, anybody's guess, but at the moment it seems like things are pretty stable. We also expect that interest rates will likely stay low for at least the next 1 to 2 years. And where exactly they will fall into this low category is anybody's guess. I've been in this industry almost 20 years. I have yet to see a standard going interest rate above 6%, which is a very long time for interest rates to stay that low. We usually will see them fluctuate more. I mean, I've heard all the stories about how they used to be 18%, and some of our clients who have, owned real estate for many years always like to comment that, getting a rate in the 2 or 3 range is like magic compared to the 12 or 14% rate that they had in the past. So interest rates are likely to stay low for 1 to 2 years. There is some talk of potentially another drop in interest rates depending on how the economy responds as some of the stimulus starts to get lifted and small businesses especially and others have to start standing on their own 2 feet and not supported by government stimulus money and activity, whether they will be able to withstand that or not. Some businesses may close. So there may be another wave of challenges that we are facing. But in general, we're going to see interest rates probably stay within the 2 to 3% range for an extended period of time, let's say 12 months, maybe more, who knows. Appraisals may continue to get to be a little more expensive and to take longer than they normally would because of the demand. Again, if there is another refinance boom, you'll start to see those timelines get longer again. They seem to be more or less settled back into mostly a normal routine, especially we had this really a lot in markets in California in particular, where appraisers were so backed up and in such high demand and low supply that it really squeezed that market significantly, in part because real estate markets in those areas were so strong at the same time that you had refinances being very prominent. So when it was almost like a perfect storm of loan applications coming in for both purchases and refinances at a higher rate, maybe significantly higher rate than normal. So we may see that again if real estate markets continue to be hot, and most of them around the country are on fire. I'm sure the agents on the call today would agree with that anything from Nashville to even New York City is really making a strong comeback this year. California, Washington State. I mean, we've seen these markets just be crazy, and great for sellers. Buyers are trying to catch up and do things that they can do to get accepted offers, but the markets are really crazy. So if you combine that with an inflow of refinance applications that gets to a high level again, we may see those timelines shift a bit in appraisals and other aspects of the mortgage process. The other challenge for appraisers is that sometimes we're seeing values go up, or in some cases down, but mostly up fairly quickly, where buyers, if they want to get an accepted offer, the markets are so competitive, they're having to bid well above asking. And it's difficult for an appraiser to support prices that don't have a historical basis for being the right price for that particular property. So appraisals are always based on what's sold in the past, not what a property would sell for right now. That's a big distinction that most clients don't really understand. They think that the appraisal is really the value of that property. But if you have, 3 comps in a neighborhood that sold 3 or 4 months ago for, let's say, $1 million, and now you're trying to buy a home for $1.1 million, that $1.1 million may actually be a viable price because you may have multiple people bidding around that price. But historically speaking, the comps that are closed and have happened in the past are $100,000 less in that example. So that's where you have these situations where you might see appraisals start to come in a little bit lower than where you'd like them to be at that new purchase price. So because appraisals are really historically flawed because they're based on what's sold in the past, not what a property will sell for right now. So self-employed borrowers, I think, are going to continue to get hit by this. I think this is going to be an issue for a long period of time for self-employed applicants in particular. What I see in our industry is that the lenders who can accommodate the non-traditional mortgages, which are very prevalent, especially in California, is one market that's very prevalent where you have a lot of self-employed people, higher per capita, so to speak. We will start to see that self-employed applicants will start to have to gravitate towards non-retail banks. Retail banks tend to be very cut and dry with their guidelines. If you don't meet the criteria, there's no way to be flexible with that. It is what it is. If you don't fit in that tiny little box, you can't get a loan from them. So I anticipate that there will be a significant increase in the market share for the lenders like Freedom that can do non-traditional transactions. So we will start to see that materialize, I think, over the next year, as we're now seeing 2020 tax returns filed, which will potentially, not for everyone, but for a good segment of the market, will show income dropping from prior years. And that the trajectory of the income for underwriters is as important in some cases as the actual numbers of how much income they're reporting. Because even if the income went down, there's still a cause for concern from an underwriter that income will continue to go down. And then how do they make the underwriting decision on how much income to use for that application? It's a bit of a challenge. So we anticipate there's going to be larger market share for lenders who can accommodate non-traditional transactions for self-employed borrowers. We have several of those options at our fingertips, so you can definitely rely on us for that type of financing if you come across it. But you need to make sure that you have a lender like us in your arsenal to be able to accommodate those types of transactions. And again, I think that issue is going to persist at least until 2024 and possibly beyond, depending on how things materialize between now and then. One of the main silver linings that I personally see, and this is dependent on where you are in the country, because different markets, again, have reacted very differently to this situation. But in some areas, we have seen declines in values. Most parts of the country, I wouldn't say that to be the case. I would say it maybe is the opposite. But we have two silver linings. One is if you're in a market that maybe is a little bit more depressed because of this in terms of property values, and you combine that with low interest rates, you have an amazing opportunity for investors to come in and buy these properties at lower prices than they normally would be able to get them for, and to set their capital at an interest rate or their loan amount at an interest rate that is lower than it would have been otherwise. So if they take advantage of these opportunities now, they will likely have lower cost of ownership, so that as rents start to recover, and that's potentially a problem area as well, which we're not really going to get into. But as an investor, if you can stomach the initial pain of having the concern about whether tenants are going to be allowed to, or maybe not able to, make rent payments during a period of time, because a lot of local governments have enforced a moratorium on, late fees or just allowing people to not pay their rent for a period of time, that can put strain on investors. But in the long run, if you secure capital at, let's say, 3% interest over a long period of time, eventually the rental market will be back to its normal routine, and you'll be at a low cost of ownership and higher profit for your investment property. So I think there's definitely some opportunities there. The second one being just low interest rates by themselves. That is partly why property values are going up in many areas, because the cost of ownership, even as a primary residence, same rationale, is lower than it would be otherwise. So you have an incentive for people to buy, and to buy during this time of lower interest rates. So I think that will continue to help the market stay strong, will probably help avoid a bubble, or at least soften it if there is one in certain markets. But I think that the low cost of ownership is something that is already stimulating our economy in the way that the government anticipated and hoped that it would. And I think, whether you agree with the politics of the day or not, I think that the financial policies have actually helped. We have seen that. It's definitely aided consumers. It's kept the real estate market strong at a time where it could have been in a really dire situation. So those are the opportunities that we see. If you have clients who have existing mortgages that have yet to refinance, I would recommend they do so sooner rather than later. We have clients who always try to wait for the perfect time to refinance, and they try to hit the absolute bottom. And what we always tell people is you won't even know if you hit the bottom probably for another 2 years. And if you wait until then, you've already missed the opportunity. So don't wait for the absolute perfect time. It's a great time right now, better than it has ever been for the most part. So if you have clients who are looking to take advantage, or you're a financial advisor and you want to be proactive and reach out to your clients and say, hey, I know you have a mortgage. Do you want a mortgage partner of ours to be able to take a look at your loan and see if there's an opportunity for you to lower your cost of ownership? I wouldn't wait on that. And I think there's opportunities for those financial advisors on the call, and also for real estate agents who want to be, top of mind for their clients. To, you wouldn't think of this as an agent normally to say, hey, client, I know I'm not involved in this transaction, but maybe you want to refinance your loan. It's a reason for you to be in touch with your client. So that's another opportunity that may not lead to a direct sale for you, but it will lead to a furthering of the relationship for you and your client. So I think those are where the opportunities are. And if we play our cards right collectively as a group, I think we can obviously get through these challenges, but they will likely persist for a period of time. And if you have the right lending partners, they're not going to be as difficult to get through as they would be otherwise. So I appreciate you guys taking the time to listen, and I'm going to take a look at the chat to try to go through some questions. Please feel free to post those if you have any additional questions, and we'll be happy to take a look. Okay, Bill Stafford from Compass Sag Harbor. Hello, Bill. Looking to see what opportunities might come through the pandemic. I think we actually just covered that one, so hopefully that was a sufficient answer for you. So we will continue looking down the list here. Oha said, I'm from NYC area, would like to learn more about the frenzied housing market. So I think we've now talked about why the housing market is frenzied. A lot of people looking to move because they're unhappy with their current living situation. The pandemic has really shown a light on all the parts of people's homes that they don't like, or the size of the home, or the location, or the lack of outdoor space where they feel like they're really locked in a box. So that's created more transactions and activity in the mortgage industry, as well as for real estate sales. So I think that has definitely led to a bit of the frenzy, as has the fear that low interest rates might not last forever. So that puts pressure on people to do it sooner rather than later, or it just gives them an incentive to do it now rather than waiting in case the interest rates do go up eventually, which we all know that they will. Okay, Chad Jeffers from Nashville, Franklin. Hello, Chad. I don't see a question there, but nice to see you. Thank you for joining us. Oh, there is a question, Chad. Okay, interested in the implications of homeowners doing forbearances on their home loans. I've heard mixed messages from CPAs and financial planners as to whether it will or can affect their credit. Some say the CARES Act protects them. So without being overstepping here, I would agree that it should not be affecting clients' credit profiles. But that doesn't mean that there aren't other implications as far as being able to qualify for a loan. But I have heard the same thing, Chad, that you have heard, that that the CARES Act does protect people from having this type of thing being reported to credit as a delinquency. And I can tell you firsthand, we've seen credit reports and what it shows during a forbearance participation period, and we can see month by month whether a payment was made on time or if it was 30 days late, 60 days late, and it will show us, you know, over the course of, let's say, 2 years, how often that mortgage was paid late, or if it was paid late or paid on time every single month. What happens is with forbearance, the number is blank. So it just doesn't report during that period of time. So it doesn't necessarily impact anything, but it will be a trigger for a lender to say, hey, I need to look at that, because of what we were talking about earlier, where banks want to know if people have participated in a forbearance program. That is a clear indication that they likely have. If that payment information is blank, an underwriter will trigger them to say, okay, they were in a forbearance program. Have they been out of it for long enough to accommodate the type of loan that they're applying for? So that's definitely something that we do watch for, but I agree it should not be affecting their credit in a negative way. But it does show up as a blank payment, which does trigger an underwriter to look more carefully at it. Okay, my good friend Tony. Hey, Mark, thanks for doing this. Absolutely my pleasure. I really enjoy doing this kind of thing, and we've got a lot of. We had almost 150 people register for this, so it's absolutely our pleasure to do this. Okay, Robin. Hello, Robin from New York. Unfortunately, won't be able to stay on. Can you send the recording to the registered attendees? P.S. Hi, Mark. Yes, Robin. I know you may not be on the call anymore, but for those of you who are, we will be sending a recorded version of this. If you want to listen in, or there's a certain part of it that you want to focus on and learn more from or share with your clients, we will absolutely be sending a link to everybody as soon as it is fully rendered by our good friends at Zoom. So maybe a few days, but we'll definitely get that out to everybody who registered. Asaf from New York. For self-employed, like real estate professionals, how the unemployment will affect their mortgage application. So we have seen a lot of people reporting unemployment income on a loan application. Depending on the industry, sometimes that's more common than others. So I would say real estate agents don't historically report a lot of unemployment income if they're actively pursuing business, but we do see it more from freelancers and things like that, like people in entertainment who maybe are doing production work, and if production is shut down for a handful of months, they'll normally in the course of a normal year will report unemployment income. So again, in general, because unemployment income is not, for most people, and this question is specific to real estate agents, not something that will be an ongoing source of income, we don't expect an underwriter to use that in their income calculation. So I think real estate agents are one of the segments of loan applicants who are definitely going to feel the impact of this. If you're in a market where the real estate market slowed down, potentially significantly in some areas, it's definitely something that's going to apply to you, and where you may, if it were you applying for a loan or one of your colleagues, would definitely be something that you would need to address, and can definitely affect your ability to get a loan or the type of loan that you might need to get, which eventually, once you establish normal levels of income again, will be able to refinance out of. But it's definitely something that can impact you for sure. Okay, Debbie Yes, very informative. Would love to listen again. Okay, great. Well, we'll definitely get you the link so you can do that. Jeff, also from New York, suppose an applicant's income has gone up in 2020 versus 2019. Okay, so in that case, we can potentially use the income, but we need it, if it's a self-employed applicant, Jeff, that we're talking about here, it would need to be reflected on a tax return before it's typically usable for a traditional underwrite. Now, again, we talked about the non-QM space and where we can do some really quirky things where we can, for example, use a profit and loss statement as the basis of the income rather than prior tax returns. And we can support the profit and loss statement based on, bank statements that show that the person really did earn more money in 2020. There are some programs that will allow us to use that income before it's reflected on a tax return. But those rates are not going to be quite as good as the traditional loan. So what we would generally recommend to someone in that situation where the income has gone up rather than down, and they want to use that income, that it's best if we have that client file those tax returns ahead of time. Now, one other implication here is that banks typically require what we call an IRS tax transcript, which is basically a verification from the IRS that a lender uses to try to match up line by line to what the client submitted for their own tax returns. This is an anti-fraud measure to make sure that people aren't using Photoshop to add extra digits or numbers to their tax returns when they send them into a lender, because they figure if they filed the same numbers with the IRS, then they are legitimate, and that's why banks do that. So what you have is situations where, for example, in the first half of the year, the IRS takes time to be able to account for all those tax returns, to enter them into their system so that they can actually provide an IRS tax transcript. And one of my good friends, Kobe, who's on the call today, and I are working on a deal together right now where the client is filing tax returns for 2020. We need that income to qualify. We were able to find a way to get our underwriters to accept not having the IRS tax transcripts and allowing us to use that higher income once those tax returns are filed, which again, as I mentioned earlier, the IRS doesn't even accept tax returns until mid-February. So as long as we're closing after mid-February, which we are in this case, we found a creative way to allow for some leniency to not have that tax transcript. I know that was a long way to answer your question, Jeff, but I hope that gives you a little bit of additional insight that you may not have been asking about. Can you speak to assets in addition to income? Question from Lauren, the financial advisor I've known for many years. Hi, Lauren. So we have some niche programs that allow us to use income or convert income into convert assets into qualifying income. So if you have a client who is either retired or maybe they've sold a business, we've used this for a lot of different scenarios. People who got a recent divorce settlement, who maybe is a non-working spouse, basically anyone who has money in the bank but doesn't have traditional income, at least enough to qualify for a conventional loan. We have products that can accommodate those types of clients and convert those assets into qualifying income so that they can get loans that they would not be able to get from a traditional lender. So yes, we definitely have some creative products. And if you have any specific scenarios, Lauren, that you'd like us to discuss with you, by all means, please definitely reach out for that. Okay. Marcia from New York. Hi, Marcia. How flexible are you in rate locks when they have expired, or if there's a penalty, or since rates remain low, one shouldn't worry? It really depends. Every bank has a little bit different policy. I think every bank, for the most part, has opened their own pockets to accommodate clients to try to not make it the client's problem when a rate lock expires, especially if it wasn't the client's fault. So it really depends on the circumstances. But what you just asked about touches on an important point, where the relationship that the loan officer has, or the somewhat of control or leverage that the loan officer you're working with has with their internal decision makers, makes a huge difference. So, for example, we happen to be, and I'm just using this as an example, this is not an eco play here, but we happen to be the top producing team at Freedom nationwide. So we may have certain leniencies that someone who does a deal or two a month might not have, as far as leverage to get someone internally to approve a free extension for a client. So it really depends on the circumstances. It's much easier to do if rates stay the same or go down than if they go up. But what you have to understand is there is a cost on the lender side to extend that. So the question is, for that particular client or loan officer working on the loan, is whether there's enough profit really left for the bank to be able to accommodate that. So it really is case by case. So, but that's a great question, Marcia. Thank you. Eric, great information. Thanks for sharing. My pleasure, Eric. Nice to see you. Okay, Ken had a question. Any thoughts, Freddie Mac asset depletion using IRA and other retirement accounts? Is it viable for self-employed? So yes, Ken, that's one of many asset depletion programs that we have. Freddie Mac offers that. Asset depletion is where you convert the liquid assets into qualifying income. It can be combined with other types of income. So it's not all, you can only use asset depletion income and nothing else. In some cases, we use it when a client is just barely a little bit above the threshold for debt to income ratio with their conventional income. We might do it on that type of program so that we can add a little bit additional incremental income to get them approved. So it's not an all or nothing thing. It can be combined with other types of income. And the Freddie Mac program is one of many that we do use fairly often. Okay, I see a lot of thank yous. Great job. My pleasure. I'm going to switch over to the Q&A. Okay, a question from my very good friend Stephanie in New York. Hi, Mark. If the sheer volume of day trading in the stock market is any indication, half of Americans are not struggling. Yes, that's true. That's if they actually have investments in the stock market, if they're fortunate enough to be in that position. But I would agree. The stock market has helped offset any negative implications they may be having in their business. So they're somewhat permanently hedged. So I think that's a very valid point. Lauren, I see your question about using assets in addition to income. I think we covered that already. And another question from Stephanie, regional differences to be aware of, especially around climate change risks specific to location of home purchase. Before formally applying, how can our clients check, then clean up small problems with their credit score and history before it drums up their application? So, we generally recommend that a client gets a proper pre-approval where we review a full set of documents upfront. And the earlier they do that, the better, especially if they think that there's going to be some problem with their financing, whether they participated in forbearance or PPP or whatever it may be. Almost like a check before you go in front of an underwriter. We would recommend doing that as soon as your clients think that they are interested in making a move, even if they're not going to make that move for 6 months. Why not do a quick check to see what's going on, if there are any issues that you could then theoretically use that 6 months to clear up. So I think that's an important point. And the earlier we get in touch with your clients, the more we'll be able to dance around and avoid those issues. So, okay. Another question from an anonymous attendee. So whoever you are, thanks for the question. Is there still not much of a difference between interest rates for a 15 and 30-year mortgage? There can be, actually, roughly 0.5%. If we're looking at government-backed loans, a 30-year fixed purchase loan for a smaller loan, let's say, $500,000 or so, is generally around 2.625, whereas for a 15-year mortgage, it's around 2.125. We're finding in some cases that there are good options with points that clients can consider. And the reason we think that points are a good option right now is because this is probably the last loan as far as refinancing to lower rates that they will ever take. So I think there's an opportunity there to set that rate as low as you possibly can. Another question from Stephanie, any regions that are relatively good value? We want to look at the ones that are struggling the most. So Stephanie, since I know you're in New York City, I would say that the segment of the market that's had the hardest time rebounding is, probably high-rise buildings where it's very difficult to be away from other people during a pandemic. So those are areas where you might be able to get a better deal, especially for properties that have sat on the market for a while. But there's some implications of that as well. We may do a session, not to plug this early, but specifically about real estate investing for investors, people who, not your big, massive developers, but for everyday people, so to speak, who may want to get into investing. So definitely keep an eye out for that. But I think finding the right area to invest and looking at closing costs for certain markets, which may be different. Like in New York, you have a mortgage recording tax that you don't have in other places, and other taxes and whatnot, I think are part of that equation. But I think most markets in the US have actually spiked up as opposed to down, and any that have spiked downward have already started their trajectory back up. So that's something to watch for as well. And Thea, and I apologize, I think we're going to go over just a couple of minutes. I just have a couple more questions to get to, and then I will publish the information for those of you from the FPA to make sure you get your CE credits. When underwriters search for other outstanding mortgages, do paid off mortgages show up? Yes, they do. They typically will stay on a credit report for at least 7 years. So even historical data on a prior mortgage will definitely be part of that. Yes. Another question from Stephanie. Thank you for all the engaging questions. This is great. If a self-employed client's income is up or flat for 2020, does it make sense for them to get their 2020 tax returns filed ASAP? It doesn't really matter if the income is the same as 2019, unless 2018 was a lower year. So because if, again, you're looking at a 2-year average, if you haven't filed 2020 returns yet, then they're going to look at 2018 and 2019. So if 2018 was a lower year, that's going to drag your average down a little bit. Nuances jumbo versus smaller in current mortgage environment. I think we've covered that to a certain degree as much as we can in today's call. But question about how can we run a credit check without a hard inquiry? There's a great website that consumers can run their own credit. And when a consumer runs their own credit report, it does not affect their credit score. It's only when a creditor does so. The website is annualcreditreport.com. And most people are entitled, well, not most people, everyone is entitled to get one report per year that is free, but that report does not include scores. So if you go to that website, you run the free report, you'll get the information that the score may be based on, but I think this may be like $10 or so. The client can pay for the scores and get that. I know also pretty much every bank and credit card company now is offering a credit score. The problem is that those credit scores that are based on consumer models are generally not in line with what we see when we run a mortgage related report. There can be sometimes significant differences to the tune of 50 or maybe even 100 points, depending on how they're calculated. Question also, condo versus co-ops in the high-rise space. I would probably defer that, Stephanie, to a real estate agent to comment on that. But I think they're affected in the same way, in that if you're in a high-rise, incrementally, the prices may have to be adjusted or maybe already adjusted, specifically so because some people are concerned about living in a high-rise building during a pandemic. So I think that pretty much is all of the questions that we had. So I'm going to reshare my screen for those of you joining from the Financial Planning Association. I will skip over to the information here. So if you want to reach out to us, all of our team information here. We have offices in New York, Los Angeles, and actually Seattle. But these are the best ways to reach us. If you're on Instagram, I would definitely recommend following me there. The Bridge Loan Guy is my handle. It's a great way to stay informed about these types of events, either that or LinkedIn, our Facebook page here as well. And for those of you from the FPA, please go to the link that you see here. I will leave this up for a few minutes after the session ends. Your code here to get your CE credits is available. Thank you to the FPA for helping us promote this event and for getting it approved for CE credits. We are a platinum sponsor with the FPA of New York, and really appreciate their partnership and them engaging. I know a lot of people on this call were coming from that group, which we appreciate all the engagement from. So I think that wraps us up. So I'm going to end our session today, but thank you again so much. If you have questions, please don't hesitate to reach out. That's why we're here. We definitely want to hear from you, and we would be happy to connect and answer any questions you have and really help you work through these challenges. So thank you so much. Have a great day, and we'll keep in touch. Take care.